Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 29th, 5:29 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week, and take a review look into the 21 over 21 leaders list. Let's get right into it. State of the market. We are in a mild correction, 7% off of the highs from late July. Check the trend gauge over here. Market leadership uh, showing downtrend, at best going sideways. Not a bad week for leaders. We'll talk about that when we get to what just happened in the tail of the tape, and that's why the title of the email for today is half empty or half full. We've got pluses and negatives going on with the overall market. Probably leading the Bears, probably carrying the ball right now. The Bulls trying to put up a goal line stand and get the ball back and try to matriculate it down the field, as Hank Stram of the 1967 Kansas City Chiefs used to say in the Super Bowl three head highlights. I'm really dating myself. That's probably because I turned 58 today. But anyway, three major indexes. Short-term 21-day moving average, all five of the major indexes trending below there, not good. Medium-term 50-day moving average, all five of the indexes trending below there, also not good. 200-day moving average, mixed bag here. We got mid and small caps firmly below the 200-day moving average. We got the Dow failing to get back above the 200-day moving average, so a first weekly close below the 200 there. But the Nasdaq 100 and the S&P 500 remain above the 200-day moving average. Public service announcement: the market does not get into serious trouble unless the S&P breaks below the 200-day moving average. We're in that area where we give the indexes the benefit of the doubt. This is the passive approach to our portfolio management. Leading stocks, on the other hand, we know from experience they face an uphill battle in a market that's correcting. All these bear markets that I'm showing here, the last 13 dating back to 1968, these all happen below the 200-day moving average. We're not there yet. We're not even close. Like I said, we're 7% off of the highs right now. So let's get going. What happened today? Well, before the market, the bulls got what they wanted with weak inflation data. In this case, weak data is good, meaning not as much inflation as expected. And we got a really nice gap up, and that was it. We put the high in the first 5 minutes, turned into an ugly negative reversal, 5-hour downtrend, a little bit of a bounce at the close. But leaders acted, over half of the 21 over 21 list was positive on the day. Only two showed losses that were significantly less than or significantly more than the overall market. And on the week, all eight of the RG8, that's our eight ETF, eight growth ETF composite, all positive on the week. So half empty or half full, ultimately the market will decide that. We just go through all of the key metrics that we track, put a plus mark, put a check in either the plus column or the minus column. It's about the weight of the evidence, as Stan Weinstein used to say. And that's what we do here at Revere. But on the day, RG8, I would have expected it to be worse until I crunched the numbers after the close. Down 0.19%. Three of the eight RG8 actually end up positive on the day. And the worst was just down 1%. That is small cap. That was small cap growth in the from the S&P 600. S&P 500 gapped up 0.75%. Very disappointing. Ended up down 0.27%. Nasdaq 100 gapped up 1%. Turned red during the day. Managed a very small positive close of 0.07%. The Dow gapped up 0.5%, ended up down 0.5%. Mid caps down 0.36%. Russell 2000 small caps gapped up 0.7, ended up down 0.5%. Global 60/40, buoyed by bonds and also, no, just bonds. The world bond index finished positive today, so a little bit of easing of rates, but In this case, the easing was not good because we got a big gap down in rates initially, and they got stronger as the day went along. And that you can point the finger at that for the weakness after the open in the market. So global 60/40 stock and bond down 0.13%, in-house GROTECTION down 0.45%. Oils with a big sell-off today. We got stopped on our NRGU, and the strongest sector in the market, uranium, with a sell-off today. Also, we're holding on to our CCJ position. We'll also talk about a couple of portfolio changes that we did when we get into the tail of the tape, and we'll review the 21 over 21. Let's dive into it. Here's the S&P 500. Let's go to the 5-minute chart. You can see the disappointment in the face of the bulls with the big gap up, opened at 43.33, and that was it. Little lower highs, lower lows, all the way down to putting in the bottom at 230. So a 5-hour trend down. Spike, fail, spike, fail. This is quarter end shenanigans, a lot of it tied to having to settle up on the indexes at the end of the quarter, but not a good way, a disappointing way for the bulls to finish the day from an index standpoint. Certainly on the S&P 500, you can see it ran into the declining 8-day moving average, actually got above it early and failed. This is our ultra short term moving average. The first thing you want to do is get above there. We got to get above there and have it curl higher before we can challenge the 21-day moving average. You can see very often nice uptrends in the market spend quite a bit of time above the 80 MA. So that's why we track that, but no go today. Failure, negative reversal. NASDAQ 100, 1% gap up, well above the 8 EMA there. I have mentioned how NASDAQ 100 has been showing subtle strength, subtle relative strength. And for that reason, when we got back above there on the first attempted pullback today, we bought a small position in QLD that subsequently failed back below the 80 MA, and we also failed, as I pointed out, in the S&P 500, and we hedged part of our S&P 500 long when that happened. So we're proactive here. We don't sit like a deer in the headlights. If something's not working, we're going to take action. It's okay to be wrong. It's not okay to stay wrong. So basically, we flattened those two, one buy, one sell, kind of flatten out each other. If you look at the stochastic here, we're trying to hook up from oversold NASDAQ 100, all of them actually trying, but the 8 ETF RG8 haven't had a better week than the indexes did. Let's make sure we're showing the weekly index chart. Hold on one second here. And there it is. So here's about the last 3 to 4 months and what we did on the week for the individual indexes. You can see the NASDAQ 100 with a small gain on the week, S&P 500 down 0.74% for the week. I'm going to take these stochastics off so we can see the charts a little bit better. So you can see we basically closed mid-range. And when you close mid-range after going down on a weekly chart, this is a 2 weekly candle setup for a morning star, very similar to the way we had a 3 daily candle setup for the morning star. It's a bottoming pattern. It means you're in a downtrend. You stop going down. You try to reverse to the upside. What we want to see now is to get halfway back into the candle from the prior week. That confirms it. Doesn't guarantee anything, as you can see with the gap up here on day 3, ran into the declining 80 MA and had a negative reversal. This is still in effect. We're still holding the lows of the day 3 candle, but weakness in the short term, and very clearly the bulls sold, or the bears took over immediately after the open with the sell-off. However, mild relative strength from leadership, as I mentioned. Let's go to the Dow Jones Industrial Average. No leadership here. Tried to get back above the 200-day moving average, ran into the declining 8, turned and faced about face, and turned for the week, closed below the 200-day moving average, down 1.34% on the week. You can see here very clear break of the 30-week and the 40-week moving average. So not good there. Let's go to mid caps. up 1.4% on the week. We have been talking about how mid and small caps have started to show some relative strength lately, but closed on the ADMA yesterday, gap up again, but failed, got back below the ADMA. So none of the indexes above their short-term ADMA. That's step one we need to take before we can attack the 21. Up 1.4% on the week, and then small caps just barely positive on the week, closing mid-range on the candle, failing at the ADMA. Consistent theme there as the bears did in fact take over, at least at the index level. Some individual names still holding up okay. When we do our sector work for the end of the week, we'll know exactly where the strength and the weakness lies. Let's go to the VIX. The VIX with a big gap down after the big gap up in the market, but put in the lows and just went higher throughout the day. Good news is it's below the 200-day moving average, which is declining. Bad news is it failed at the 21-day exponential moving average and is in the 1750 level. We want to see this get back below 15. Or the bulls want to see it get back below 15. Let's go to the dollar. Dollar initial weakness, which was good. But as the day went along, the dollar got stronger in the morning as we were selling off, formed a cup, another move up, and then just based into the close. But definitely a disappointment here with the dollar gapping down but not staying down. Found support at the ADMA and bounced off of there. What did that mean for precious metals? GLD. GLD lower low closed at the lows of the day after a gap up. Terrible, terrible weekly candle down 7.2%. GDX gold stocks, negative reversal, not making a lower low, down 2% on the week. No, down, hold on. Let's get the percent right. Down 6.8% on the week. I was showing the point drop and not the percent drop. I need to correct that. GDX, okay, SLV. Silver negative, major outside negative reversal on silver, making lower lows on the week, down 5.75%. Let's go back and get these percentages right. I hate quoting incorrect information. So not down 7% on the week, down 4% on the week. And we're going to fly through the indexes to make sure we got the right percentages here. Yeah, S&P down. Yeah, indexes are okay. S&P down 0.74%, NASDAQ 100 up 0.10%. Dow Jones Industrial Average, that's an index. So we know that that is down 1.34%. Mid caps on the week, not up 1.4%, up 0.31%. And small caps, let's get these numbers right, just barely positive on the week. What'd the VIX do on the week? VIX up 1.86% on the week, and the dollar. I'm sure that was up on the week, and it was by 0.68%. All right, Bitcoin. Always include that with the precious metals, up 1.4% on the week. That continues to be in a tight range. All right, let's flip to bonds now. Bonds initially did exactly what the bulls wanted them to do. Prices with a big gap up, meaning yields with a big gap down, but this is certainly not what we wanted to see. A trend down day in bond prices on the week. Bonds down 1%, which means the broad yields are going to be higher. Let's look at TLT. This is the long bond. Uh, Basically flat on the day, but again, looking at the 5-minute, you see the gap up and trend lower. On the week, down 3% is TLT. Now let's look at the yield, 0TYX. You can see how it bounced off the ADMA, closed at the highs, up 4% on the week. And TNX up 3% on the week, again, bouncing at the ADMA. So that's the inter-asset correlation. Let's get to the tail of the tape, and then we'll wrap it up with the 21 over 21. A couple of green shoots here with the stochastics. I talked about the outperformance of the RG8. Let's go through the RG8 real quick to eliminate all doubt. We start off with IWO. This is the Russell 2000 growth. You can see the negative reversal on the day, ended up positive on the week, up 0.31%. Next up is the small cap 600 growth. These are more quality companies because they made it into the S&P index. Not a lot of junk in here. Down 1% today, negative reversal at the 21, up a 0.5% on the week. Next up is MDYG. This is the mid cap 400 growth. Cap 400 growth. These are going to look a lot alike. Above the 21, but failed. I'm sorry, above the ADMA, but failed into the declining 21, up 0.44% on the week. Next up is the IBD 50. This is one of the best measurements of leading stocks, negative reversal, still up 1.6% on the week. I put a little bit more weight in that, metaphorically speaking. I weigh them all equally when I divide, and just added changes up on the day and divide by 8. But I do like to see FFTY and ARK-K do better, as well as SPHB. Let's go to SPHB now. This is large cap, high beta names. Positive on the day, up a 0.5% on the week. It was low volatility names, and we've talked about this. Why would people and institutional money managers too, why would they want to take a chance in these supposedly safe haven index stocks that pay maybe a 2 or 3% dividend when they can get 5+% in short-term T-bills? It's a theory, it doesn't matter. I mean, it's human nature to try to explain something, and what we're doing is talking about the weakness in these so-called safety stocks versus the more high beta indexes, and SPHB has been really outperforming SPLV, which is low volatility. Let's go next component, QQQJ. This is like a mid cap NASDAQ 100, up 0.6% on the week. And positive on the day. I said 3 of the 8 were up on the day. PDP, this is a Dorsey Wright Momentum ETF, down on the day, barely positive on the week. ARK-K, big risk signal of risk on, rejected at the 200-day moving average, closed right on the ADMA, up 2.2% on the week. So that's another sort of green shoot that we're looking for. We're looking for looking for the evidence, sifting through the data points, trying to come to a conclusion, weighing the good against the bad. So news, I said the PCE inflation data below expectations, also consumer spending below expectations. These are things that the Fed wants to see, that the economy's slowing a little bit so they can stop raising rates, which is what the market certainly wants to see. O'Neill rally attempt still alive. It's day 3, even though it was a negative reversal day. 11 days below the ADMA on the S&P. 11 days below the 21 EMA on the S&P, likely government shutdown, as the Republicans couldn't even pass a bill to get to the Senate, but they canceled the recess, so I guess they're going to be working this weekend, but as of now, likely shutdown. Expectations negative with this being below the 21 EMA on the S&P and the NASDAQ 100. From a sector standpoint, semiconductor, software, regional banks, and retail up on the day. Negative reversal on the dollar. Negative reversal on bond prices, which meant yields spiked even though they closed negative on the day. Oils beat down today. Uranium weak today. XLF and XLV. That's broad financials, not banks. As you can see, banks were positive. Banks are a component of this, but banks and healthcare weak today. So what do we do in the portfolio? We sold NRGU. This is also punted off the 21 over 21 list. Basically a failed breakout. Nice move up for oil stocks on Wednesday, follow through on Thursday, big negative reversal today, closed below the 21. We closed the position for a 3% loss on a 2% position. That's a 0.06% impact to the negative on the overall portfolio. I don't know that oils are done. I just didn't like how they worked today. And when we close it, when we have a position negative going into the end of the week, very often we close it. CCJ, the only other individual name that we're holding, negative reversal here, but it does have some volatility to it. It's kind of consistent as long as it's holding the 21. We're going to hold on to that, but down 3.7%, down 1% on the week. Looks like it's just kind of 3 weeks tight-ish action. the weekly uh, bars a bit more volatile than we would like them to see, but closing tight for 3 weeks there. And then I mentioned QQQ. We bought QLD when we got back above the ADMA and showed strength and relative strength, but then offset that with SPXS when the S&P 500 broke back below the ADMA and failed into the ADMA and continued to the downside. So those are the portfolio changes. Reduced our beta from 0.7 to 0.61. Bottom line for the week, PCE gap up, but S&P and NASDAQ fail at their ADMA with a negative reversal. Leaders show relative strength. Glass half empty or glass half full. That's kind of the theme of this week's big show. But Bulls had a chance today, and they failed. Are still a couple of positive points that we can point to. All right, let's get to the 21 over 21. I mentioned that we punted out. Let me sort these in order. I mentioned that we punted out NRGU, and we did. Only two new stocks. So that again, that points to the strength in the 21-21 list. We didn't. We only had to boot two of them out, and actually we only had to boot one of them out, but we also punted out QLYS. One of the leading sectors and one of the sectors that's really holding up and showing relative strength, you can see the relative strength line here, is software security. QLYS, it's a bit on the thinner side. It was showing relative strength, not so much this week, but it did bounce at the 10-week moving average. But Zscaler and CrowdStrike acted better this week, and they're more liquid. You can see the gap up there, break of that downtrend line, very clear. Up 2.6% on the week, up 3.1% today. We went with Zscaler. Could have gone with CrowdStrike, but we went with Zscaler. Just a little bit stronger on a relative basis, although we're watching this also up each of the 4 days, bounced to the 50-day moving average, up 3% on the week. So Zscaler and or CrowdStrike. We also, Duolingo. Why do we want to keep our eye on this? This is one of the first, well, it actually broke out and then failed while we were correcting, bounced off the 50-day moving average, and then tried to break out again. So this is a properly formed double bottom base and another breakout attempt on there. You know, breakouts fail during weak markets. We're going to keep an eye on this. 67% above average. You can see blue bars much more prevalent than down bars. Relative strength confirming the price breakout. And we put this on here because it's, let's call it the canary in the coal mine. It's a breakout of a stock. It's a growth name, increasing sales and earnings, and let's see how it acts. These first couple that have to come out of the chute, oftentimes they come into big leaders. Remember, we can have a follow-through day on Monday under the O'Neill methodology, and we don't predict anything. Again, weighing the evidence. Duolingo, one of the early breakouts from a sound base. Molina Healthcare sitting on the 21. Remember, you can look at what did it do for today, the candles, and then what did it do for the week, and the percentages in the upper right hand corner. So Molina Health holding the 21. Sam, nice relative strength here, up 3% on the week, 1.9% today, increasing relative strength. QLYS, I punted that and replaced it with, as I said, Zscaler. Sienna, undercut but reclaimed the 21 by the end of the week. FedEx, up 1.5% on the week, near the top of its base, a defensive type name. Textron also forming a tight consolidation after its a gap up on a contract 2 weeks ago. Looking good. Abercrombie and Fitch, retail apparel company, nice bounce off the 21. This isn't really a base breakout. It's not long enough, but it did have its big gap up on earnings almost 5 weeks ago, so certainly considered a leader. Ollie undercut the 21, reclaimed it by the end of the week, also a bounce off the 10-week. CF Industries making a higher high this week, up 1.8%, trending higher along with relative strength. Fabrinet, big move up on Thursday, and a tight consolidation at the highs. Really nice looking weekly chart here, making a higher highs up 6.75% on the week. CEG Alternative Energy pulling back, closed on the 21-day moving average. Mobileye entered the week as the only semiconductor stock that was above the 21 EMA and was up 3.8% on the week. BRBR, Bellring Brands, undercut but reclaimed the 21 by the end of the week, flagging nicely on the weekly chart. Akamai, tight consolidation after trying to break out of the flat base. Breakouts don't work in a weak market, but we're watching for this one to uh, get the gusto back, get its mojo back. If the market rights itself, this has the potential to be a leader. Lost money this year, or didn't lose money. Earnings per share declined this year, but reaccelerating next year more than the PE. So that puts a PEG ratio under 1. When we see that, we pay attention, especially if it's a potential growth leader. Dell continuing to pull back and consolidate after its earnings gap up. Elastic above that 80 level, up 2% on the week. Really nice action. Nutanix, bit volatile this week. They had a analyst presentation this week, Investor Day, and consolidating up near the highs after its earnings gap up. CCJ, this is the one from the 21 over 21 that we own. Tough day, down 1% on the week. Very clear leader. I already talked about the 3 weeks tight pseudo characteristics. Coal stock, CEIX, just barely down, up 11.6% on the week. Amazing. TBT, this is our index play. We don't own it currently. We have in the past. It's above where we sold it. We sold it when it was extended. It got more extended, up 6.4% on the week. If interest rates go higher, this is going to go higher. So this is one that I would love to punt off the 21 over 21 list, because that means interest rates are coming down, and that would be beneficial for growth stocks. And that is going to wrap it. As always, like to hear from you. The email is don@revereasset.com, or my partner Dan Stewart. If you're interested in becoming a client, dan@revereasset.com. The phone is 855 Real Wealth. That's 855-732-5932. If you're watching us on YouTube, feel free to comment. We reply to all of the comments. And like and subscribe and repost it, pass it on to as many people as possible. We are trying to get the word out there. You don't have to be a slave to the market. You can participate when markets are uptrending. You can get out of the way or reduce exposure when they weaken or go sideways. And with that, I'm going to remind you, it's not how much you make in the market, it's how much of that you can keep. And I will wrap up the month ending and the quarter ending Friday, September 29th. This is Don Vandenbord with Revere Asset, telling it like it is. Thanks for listening and have a great weekend.